Well, welcome to today's Trade Tracker Special Edition. I have some very exciting information to share with you today. Before we get into entries, indicators, trade setups, or position sizing, we need to first talk about where price is operating within the overall market structure. I'm going to introduce to you today probability bands. Many traders are not even aware of these bands or these probabilities, so obviously they skip this step. It's very important. And this is one of the main reasons why many traders have inconsistent results and struggle so often. Most traders don't fail because their entries are bad. They fail because they treat all price levels the same when placing their trades, regardless of where price is within the structure. That's why they fail. They treat all price levels the same when placing their trades, when in fact, all price levels are not the same. Price doesn't behave the same everywhere. And if you don't understand where you are within the structure of prices, even good entries can quickly fail. In this Trade Tracker Special Edition, I'm going to introduce probability bands. Probability bands are the framework that you need to be aware of before placing any trades. They show you how the market behaves differently depending on where price is located within the bands. Think of this as a map of probability behavior, a way to understand where price is and where it trades easily, where it struggles, and where it abruptly changes direction. Keep in mind, the market is nothing more than an auction of bidders. Imagine an auction of cars or paintings or anything of value, okay? At some price points, there's going to be a lot of bidders. At other price points, there's going to be way less bidders. And at the very extreme price points, there's going to be relatively few bidders, and oftentimes they can dry up. And that's what creates quick, wicked turns in the market. And if you're not prepared where you are within the structure, it could definitely catch you off guard. What I'm going to do is I'll show you a band representation of those probabilities I just had up. All right. At extremes, like in the top red area there, bidders are extremely imbalanced, and that's when the fast, sharp moves happen. Trades can quickly go against you, and if you're unaware where you're trading in these extreme zones, you can be whipped out of your trade very quickly and wonder why your stop losses got hit so extremely fast. Okay, most traders don't even know these zones exist. They're very important. So let me explain to you how to read these probability zones. These bands represent where price spends time. Okay, where the curve is thick and wide, like this green area, okay, this is where price tends to want to spend most time. Where the curve thins out, price tends to spend less time, like in this yellow area. And then the red area, that's where a lot of the whippiness takes place. And a lot of traders get whipped out of their trades and they wonder what happened. Okay. These bands identify how long price stays in an area. And then we place probabilities on here. Most traders focus almost entirely on entries. They assume that a better entry will fix their inconsistent results, but that's definitely not the case. Okay, there's a lot more in trading than just trying to pick the ideal entry. As a result, they start down the endless path of looking for a better indicator or a better setup to improve their trading. This search is never ending for many traders. When their trades fail, they go searching indicator to indicator, setup to setup, never getting out of that trap. When I coach traders, it's not their setup that is so bad. A lot of traders have a very good setup, okay? But what I find, it's where they're placing their trades or where they're taking their trades within the structure that needs a lot of work and often can be very disastrous to a lot of traders. It's where they are taking their trade within the structure that's bad. There are also probability zones for long trades as well as for short trades. Oftentimes, my coaching students learn very quickly that their trades are often taken in the wrong location, at the wrong time, within the wrong structure. They don't even realize what they're doing wrong. It's not their entry, but it's where in the probability zones their entry occurs. What they discovered was that they were on a journey of trying to fix the wrong thing. As a result, they were continually getting frustrated as to why their trading was inconsistent because they're trying to fix the wrong area. Let me explain how this works. The middle of the structure is where the market wants to spend most of its time. The edges are where the moves are faster, risk is higher, and mistakes are punished. You need to know where you are operating before deciding to take your trade setup. The green zone is where prices are traded easily, right in here. This is where buyers and sellers are balanced. And this is where they agree most about the price. This is where the market is most comfortable trading. This is where most bidders feel price is fair. So there's going to be a lot of bidding going on. And this is where price usually wants to gravitate, is to this middle green area. This is where the market's most comfortable trading. It's the equilibrium area for price. I call it the happy place for price. When price moves away from this zone, it often wants to come back. It's like a magnet, not because it has to, but because this is where buyers and sellers are in agreement on price the most. The gold zone is where price starts to struggle. Balance begins to break down, participation thins, price wants to move around a lot more. This is a zone where many traders get chopped up because price moves up and down very quickly. Price is indecisive and wants to move away from this area right here. This gold zone demands a lot of discipline, patience, and much tighter risk control. Now, the red zone is where risk abruptly changes. This is very dangerous. If you don't know you're trading in this red zone, that's where you can get whipped out of your trades very quickly and your stop losses get hit fast. The red zone is where risk changes abruptly. You need to be very careful trading in the red zone. You need to be aware that you're in this red zone if and when you're trading in it. These are extremes. Price doesn't like to spend much time here. It's like a stretched rubber band. It wants to pull hard back the opposite direction. Behavior changes quickly in this zone. Moves accelerate, they stall, they reverse, or they just fail suddenly because price within this part of the structure is strongly being pulled away from here. It's like a repelling magnet. It wants to move away. It's uncomfortable in this zone. This is where mistakes get very expensive if you don't understand where you are. These probability zones don't tell you to buy or sell. They tell you what kind of environment you're operating in. Entries and execution come later. I'm going to be covering that a little bit later in this video. Think of a casino. Casinos don't predict the outcome of the next bet, but that's what traders try to do. They try to predict what the outcome is going to be. That's the big problem many traders have. They try to predict what's going to happen. That's a big mistake. Casinos are obviously extremely profitable, and they never try to predict what's going to happen next. They usually win. Why is that? It's because casinos understand the probabilities of the game. They have their probability structure in place for every game in the casino. They simply rely on probabilities. That's it. And these probability bands do the exact same thing for a trader. We don't try to predict or guess the outcomes. We operate and trade only where the probabilities are structurally favorable to our advantage. Most traders lose money because they execute without understanding the probability structure they are trading in. In the Apex Traders Club, we're going to dive into these in much more detail, and I will show you how to use them to place trades. Now, let's take a look at how these actually played out in the market this past week. All right, what we have here, this is the different zones. So if I go back to our bands here, what I did, I simply took these probability bands that I work up. These are based on an algorithm that I have. There's mathematical algorithms that play into this. But this helps us identify where trading is most likely to gravitate. Okay, we have our core acceptance band, and then above and below that, we have our upper acceptance band and a lower acceptance band, and then our upper extreme and our lower extreme. These percentages identify how much time price wants to spend in these various zones. So as we can see here, as long as the structure exists, and the structure is defined as this top from 26,124 down to the bottom of 24,160. As long as we're trading within there, we can safely assume the probabilities are 54% of the time it's going to want to trade here, 18% in this zone, 38% in this lower acceptance, and then 8% in the extremes. I took these exact zones and I put them on the chart. Okay, see how it played out this past week. I'm going to show you the entire week and see how it looks. First of all, what I have here is 25,374, 25,740. The lime dark green lines. That's exactly what we have here. 25,374, 25,740. So 54% of the time, prices want to trade within this zone right here. Now, what's interesting is we also have another zone that's overlapping, this upper acceptance zone of 25,660 to 720, which is right here, 25,660 to 720. That 18% overlaps within this 54%. Now, that's huge. Why is that huge? Because now we have this area of 660 and 720 within the happy place of 54%, this core acceptance zone. That means price is going to want to gravitate a significant amount of time within these two bands, just like it's bouncing up and down here. So the upper acceptance zone inside the core acceptance zone, this is where price wants to go for equilibrium. This is where buyers and sellers are most in agreement. It's not being strongly pulled in either direction, and price is balanced in this zone. Let's see some other zones. If we move up, this is the 8% upper extension zone. These are those same numbers at the top, 25,900, 26,124, just like we have here, 900, 26,124. Now below the core acceptance, we have our lower acceptance, 2,500, 25,250, which is right here, 2,500, 25,250. And below that, the lower extreme zone. This is January 16th. I'm going to go all the way back to the first of the year to show you how price operates within these zones and how powerful it is. As you can see, price came down, bounced exactly off this bottom of this core acceptance zone, 25,374, and then moved up. Respected it tremendously. Now keep in mind, these are not trading signals. This is not buy and sell signals. This is strictly a filter for your trading strategy. Whatever you're doing, these zones are going to significantly help you in your trading. Whether you use the Apex multiple time frame breakout strategy, which I'll show you a little bit later in the video, or you have your own entries, whatever entries you want to use, if you place them within these probability zones, you're going to see a significant improvement in your win-to-loss ratio, because you're going to be entering not only good entry, but you're going to be entering it also in a key zone rather than just haphazardly within any place within the structure. Here's 25,374. That's what I was mentioning before. It bounced off there. Now we're going to continue going backwards in time. This is January 15th, going back to January 11th. Here's our 25,660, 20, and our 250. Those two separate zones there. Right in the middle is the acceptance. You can see how price is operating. It bounced right off this 25,250, bounced right off there. Now if we continue going forward here, 25,250. Now look at how price is operating within these two bands here, within the 660 and 720. Go back a little further. Yeah, see how it's bouncing, it's gravitating right in between 660 and 720, okay? It's just so much going on here. It's just these bands are phenomenal. These circles are where price closed. This is January 12th close. This is the stock market close at 3 o'clock Central. This is the 13th. Next, I'll show you the 14th and the 15th. You'll see how the closes are right smack dab on these bands. So here, price moved up, and look where it went. Right into our resistance zone, right in the middle of the 25,900 band, right in between our key resistance zone, 968, 998. That's where the market closed, January 12th, January 13th. Now look at this upper acceptance zone, 25,720 to 660. Look how price wanted to gravitate within that zone. Didn't know which way to go. It's bouncing all over the place. That's a very tough zone to trade. So if you're in that zone, you need to be aware you're in there, and we'll show you entries on how to safely take trades once the price breaks outside of it, either up or down. Now look at this. This is the close January 14th, January 15th, and January 16th. Look at that. That's that upper acceptance zone I was telling you about, the 660 and 720. Look at price closed exactly in the middle, dead center of the overlap of these two probability zones. It's amazing how price wants to gravitate like a magnet right in between the zone right here, because this is overlapped in between the green zone. So the point is, a lot of these zones are like magnets. Price wants to gravitate to them. As you can see here, we got as high as 25.9. Price got up there, wanted to come right back down in the middle of our upper accepted zone. Price shoots back up, wants to come back down to the zone. What I'm going to do, now I'm going to go back here and show this too. This is really interesting. For those of you that were watching my other trade tracker videos, you remember this chart. We had the price moving 500 points beyond our 200 moving average. The point I want to illustrate is look at where price and the moving averages all touch the exact same place. This is Thursday, January 15th at 3 o'clock. Look, price hit exactly where the moving averages crossed. When was that? Thursday, January 15th. Let's go back. Thursday, January 15th. Look at that. That's right in the middle, smack dab the center of our two zones we talked about where price wants to gravitate to, between 25,660 and 25,720. It's amazing. And by definition, this is proof that it's the middle zone because everything is identically the same right here, right? There's no pulling in either direction. Like there's pulling here, push and pulling at the extremes. In the middle, it's a happy place. Price is happy here. There's no pulling either way. The moving averages cross, price is right there. Price is happy here. This is where price wants to come back to. Let's move forward here and let's just show some trades and then I'll wrap this up. This is January 12th. I'm going to show the whole last week of trades, the 12th, 13th, 14th, 15th, 16th, all the way through, Monday through Friday. I'm not going to cherry pick. I'm not going to pick trades. I'm just going to show you the whole week, just to show you how this worked, okay? You can see how it is tagging these major areas here. Our zones is hitting them. But the question becomes, how do you trade this? Well, the Apex Traders Club, we're going to be opening up soon, and we're going to show you how we can parlay trades into this to help you. For example, we have our breakout strategy. Comes right up to the band and we sell it. That's a beautiful trade. And we have our stop losses and our profit targets along the way. Next one, 25.9. Price shot up right up to that resistance zone we talked about before. Look where it gravitated, right in the middle of that 968 to 998 zone. How do the trades worked out? Well, we had a buy down here, we had a sell over here. These are automated breakout signals for the Apex multiple time frame trading signals. Okay, there's a buy there, and we see a red arrow. It's kind of hard to see, but the red arrow there is a sell. We're going to show you how to place trades, put your stops in, have your profit targets along the way with the runner. Here's another one. You can see how it gives you an idea where price wants to turn. Once again, there's the two prices here, the 968, 998. Right here, it's a 25.9. That's one of our big zones. Price gravitated right there. How do you trade that? Well, as you can see, we had some long trades here going up, these blue arrows. There's our seller right there. We're going short all the way down here. And when we put our stop losses in and our profit targets, okay, if you had the various staggered profit targets we're going to teach you, you take profits along the way. And when price comes up, we have our trailing stop. We're going to show you how to trade these, okay? Here's another one. There's 25.9 again. Price is coming up. You can see once again how it bounced between 616, 720. It bounced right in there. Once it breaks out, it wants to go higher. Where? To the next level. So when we factor in our trades, there it is. There's our buy right here. There's our sell up here. We're going along this whole way. Of course, we have our stop losses down here. We have our profit targets along the way, and we have our runner. So we're going to show you how we do this. And once we get involved here, if you choose to join the Apex Traders Club. We came right down here. See, these are 660, 720. Look at price. See how it's bouncing right in between those gold lines? That's that happy place I was talking about. That's where price is most happy. Why is it a happy? That's where buyers and sellers agree the most. When price shoots up, where does it go? It goes right here to 25,900. The market gets out of balance there, and it comes shooting right back down to our zone here. How do the automated trades work out? Back here, we had our short. It covered, went long again here. We got out over here. We're doing our stop loss. We're taking profits along the way with our staggered profit targets. We'll show you how to do that. We go short here. We have staggered profit targets down here. Then we went long here and got out up here. And then we're going to show you how to do them. These are all automated trades. I didn't set this up. I didn't pre-do any of this. This is how the actual trades triggered live. For those that want to join the Apex Traders Club, I'm going to be shooting out these screenshots live as they happen, tell you exactly where we're putting our stop losses, where we're putting our triggers, so we can capture a lot of this move down here. You're not going to capture the whole move, but you can certainly capture quite a bit of it. We went short at roughly 25.8. The move went down to 25.6. That's 200 points. If you get 100 points of that, it's pretty good. I'm going to wrap up there. I think that's long enough for today. So if you like what you see here, don't forget to subscribe. On the bottom right, you should see the YouTube subscribe button. Click subscribe. And I look forward to keeping you in the loop and helping you improve your trading results. Talk to you soon. Bye.